Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
This is ETF Market Insights. I'm Danielle Nuzzle with BMO ETFs. It's so great to have you back, whether you're joining us on our YouTube channel or on GoToWebinar. Really terrific to have you with us again this Friday. Just as a reminder, we are not providing you any advice today. We're not providing you any recommendations. Today's show and all our shows are about talking about the markets, providing education for do-it-yourself investors to really empower them to take over their own portfolios. We have Alfred Lee here from BMO ETF. So Alfred is an overall ETF expert, but he's also a director, portfolio manager, and ETF strategist at BMO. And Chris McKinney couldn't make it today, but we hope he's at home tuning in. And a reminder, if you haven't visited our YouTube channel yet, definitely check it out. All our episodes are there on demand for you to watch whenever you'd like. Click subscribe, and if you turn your notifications on, you will be notified when we go live each Friday. Our 1 minute ETF update is all about flows, and what we found really interesting from the April numbers that were just published by a national bank is that flows, we saw actually negative flows come out of crypto asset ETFs. So if you remember last year in 2021, crypto ETFs were all the rage. They were listed here in Canada before they could be listed anywhere else in the world, saw a huge inflow of assets. And now with heightened volatility in the asset class really cooling off, we're seeing a lot of people selling off those ETFs. So interesting to highlight that. Now, today's session is all about allocating cash in uncertain markets and thinking about how to deploy cash or putting your cash to work if you are sitting on some. And if you are like one of the many Canadians out there, you might be sitting on a lot of cash. Just looking at this study from BMO Capital Markets that was published in the Globe and Mail, there's currently about 113 billion worth of physical money in circulation in Canada right now. That's up 25% from pre-pandemic levels. And overall, we're seeing in Canada, household finances have actually strengthened coming out of the pandemic. This is because people were locked down. They couldn't go out to restaurants or other places that were shut. They could not travel. So Canadians are actually sitting on more cash than they have in the past. And a lot of them are questioning markets right now, given volatility. And we actually got a question from one of our audience members on this exact subject, so we thought we would do an entire episode on it. So Alfred, I'm going to pass it off to you to talk through this one. Can you kind of open up the conversation and talk about why is cash, how is it a benefit, and how can it be a problem in inflationary environments specifically?
Sure. I mean, the benefit of cash is obviously, cash is king, as they say. Sitting on cash, it's liquid. It's a store of value. However, I'm sure a lot of your listeners and viewers will be very familiar with a lot of the headlines that have been going around. Obviously, the headlines about inflation have been growing stronger over the last 6 or 7 months or so. I'm sure everybody is feeling it, whether they're at the gas pumps or just, the cost of normal goods and services have been going up as well. So the cost of living has been going up. So inflation is a problem for cash today. So I thought this was a good chart that illustrates, the problem with cash in today's environment. So, just a couple of years ago, when you look at inflation was 2%. So generally the central banks like to aim at a 2% inflation rate that typically, ensures that there is economic growth. A couple of years ago, the interest rate was 0, which is atypical, but at least inflation was under control. Fast forward to today, however, and, inflation obviously is a lot higher. So when you look at the CPI reading, which is generally, the most readily kind of, acceptable kind of measure of inflation. In Canada, the last reading was 6.7%. And then when you look at the 5-year government of Canada yield, which is 2.7%, when you back out the rate of inflation, your real yield is essentially 4%. And even when you kind of look at cash or GIC as a proxy, I looked at GIC rates this morning. The BMO rate's about 1.4%. So when you back out the rate of inflation, your real yield is about negative 5.3%. So in this environment, cash isn't necessarily king. The problem is that if you have $100,000, maybe a year from now, 2 years from now, your real purchasing power of that $100,000 is going to be a lot less, or notably less, because of inflation.
Yeah, thanks for talking us through that. It's such an important point for investors to really realize that inflation number, always back it out of your annual return, right? Something to think about, whether it's 2% or 6%, you always need to make at least that inflation hurdle to maintain that purchasing power. So here's a visual we often use in the field, and it kind of just shows, we're talking about market volatility, investors thinking about getting into the market, maybe feeling nervous given the way volatility has really cranked up this year. And what this visual just kind of aims to show is two different types of portfolios. So we have a 60-40. So we have a portfolio with some fixed income and some equities. And then we're looking at just a portfolio of the broad Canadian equity market. And we're looking at it over time and over different types of market conditions. And really what this just aims to show is staying invested over the long run pays off in the long run, right? And if you have a long time horizon, if that's part of your investment thesis, and you have the time to ride out market volatility, this pays off over the long run. And then you can see below Canadian inflation, that baby blue line on the bottom, and then the 5-year GIC number as well. So that can give you, the GIC can give you an idea where you'd be if you were just in cash or in a something close to a cash-like instrument. But again, staying invested over the long run historically has been a powerful way to invest. And here's just kind of another way of looking at that data. So what we're doing here is we've basically just tracked a $10,000 investment in the broad Canadian equity market, looking back to 2007. And we just pulled one of the investments out of the market for a short period of time. You can see I've highlighted that there. And what this is just illustrating is that the investor in this hypothetical situation was never able to catch up to the investor of the blue line who stayed invested through the market downturn. So just another kind of visual to show that staying invested over the long run is powerful if it's part of your investment thesis, if you can maintain and stay in for a longer investing time horizon. Now, when we think about putting our cash to work and allocating cash in certain markets, I've put together a bit of a decision framework here when you're thinking about investing in markets like this where there's so much uncertainty. So as an investor at home, you're going to have to ask yourself a few questions about your own investment profile. And some of those things are you bullish or bearish? What's your thought on the economic recovery? What are your thoughts on fiscal stimulus and monetary stimulus? What are your thoughts on inflation? All those things are going to factor into how you uniquely will be investing. You also want to look at things like market valuations. But then I think the most important thing you want to consider is your investment objectives, your time horizon. If you need liquidity, if you're going to need these investments within 12 months or 24 months, that's a huge consideration to make when thinking about getting in markets like these. We did a fantastic show last week on building a portfolio. Check it out, it's on our YouTube channel. It talks you through kind of the considerations with your objectives and time horizons. But that's sort of a decision tree that investors should be thinking about if they're considering putting cash to work in this type of environment. And I'm just showing here on the right-hand side, this graph is just a relationship between the VIX, which is the measure of volatility, and the broad US equity market, the S&P 500 index. You can see how as volatility really starts to pick up, equities tend to sell off or cool off. Now, Alfred, there's a lot of investment options and ETF options out there along the risk spectrum for investors to consider by putting cash to market. So we're going to cash to work. So we're going to start at the most conservative end of the spectrum, the most cash-like instrument. It's a money market ETF. Can you talk to us about this, the benefits and how it works?
Sure, and I think you raised a good point. I think, staying invested or staying the course is very important in terms of your overall long-term investment objectives. But there are times when you do need to go to cash. Say, for example, if you want to, if you have a large purchase coming out, whether it's a house, a renovation, tuition, or whatever it may be, there are certain times where you need to move to cash in order to lock in those, market gains that you've had in your portfolio. So money market ETFs are a good solution for that. So with money market ETFs, essentially these ETFs invest in very, stable and risk-free investments. So things like Canadian T-bills, banker acceptance notes, commercial paper, all very short-term as well. So, the average term to maturity is about 90 days and no longer than 365 days. So the thing is that not only are they very stable, but they're also super liquid as well. So, with an ETF, a money market ETF, you could place a trade. If you had to place a trade that was $100, no problem. But even if you had to do 100 million, that's no problem with a money market ETF without impacting the underlying market as well. But the key point here is that, the preservation of capital is the key point here. The NAV on money market ETFs are going to be stable. So in the event that you need to move out of cash and you want no risk at all, you want to be able to sleep at night, the money market ETF is your solution. Again, you have liquidity. Compared to a GIC, which, a GIC is going to lock up your money for, 1 year, 2 years, 3 years, whatever it may be. A money market ETF, you can technically buy it and sell it in the same day as well. So it's a lot of liquidity, not just in terms of the size of your trade, but also in terms of the timing of the trade as well.
Great. So for someone looking for the closest cash-like instrument possible within an ETF, maintaining that liquidity, that preservation of capital, and then a small yield pickup just to kind of pick up over just the difference between sitting in cash are some benefits of a money market ETF. Now, moving along within the fixed income spectrum, we also talk a lot about ultra short-term bonds as having a lot of cash-like properties. Alfred, can you talk us through this solution?
Yeah, so this one, I would say, the ultra short-term bonds are essentially one level up in terms of your risk degree. So it's slightly more risky than money market. We consider them, cash plus vehicles. So, the difference is that the net asset value or the NAV may not be stable. It will move from time to time. They're going to be very small increments, but the yield is going to be a little bit more because what we're investing in these ultra short-term bond ETFs is essentially, typically bonds that mature in less than 1 year. So in addition to T-bills, we could invest in things like corporate bonds in order to get more yield. It's going to be all investment grade, so it's still going to be pretty low risk in terms of default risk. But because we are investing in corporate bonds, there is going to be a little bit more yield, but you sacrifice a little bit of liquidity. But in normalized environments, with ultra short-term bond ETFs, still super liquid. We do trades in, hundreds of millions on our ultra short-term bond ETFs all the time. But again, the key difference here is that NAV may not be stable. What I will highlight, however, is that, as interest rates go up, that's going to have an impact on some of the bonds in the underlying portfolio. But because we are holding them until maturity, they ultimately end up at par value anyway. So, from time to time, if you get an interest rate shock, it will kind of move the NAV, but ultimately the bonds, essentially move back to par value anyway. So there may be short-term fluctuations, but ultimately it is stable if you hold it over the long term. But again, the key thing here is that there is no lockup period. So compared to a GIC, there is no minimum holding period for ultra short-term bond ETFs.
Thanks, Alfred. So basically an ultra short-term bond ETF like a ZST is holding a portfolio of corporate bonds less than a year to maturity, and we're holding those right up till maturity. So they are at par at the end. So thanks for explaining that to us. Now, over on the equity spectrum, so moving away from the fixed income options you talked through, which we categorize them as on the low risk spectrum. So now looking at more defensive equities for maybe those investors who have a little bit of a longer time horizon, who'd like to get into equity markets but want to do so in a defensive solution. Alfred, can you just speak to why covered calls work well and in volatile markets as well?
Sure. So with the covered call ETF, essentially what we're doing is we are investing in, typically with our strategies, what we like to do is, invest in dividend or defensive paying equities. But in addition to that, what we're doing is we're writing call options on top of that. So by writing call options, not only are we getting the dividends of the underlying stocks that we're investing in, but also we're collecting those premiums from writing those call options as well. So one good thing about covered call options is that the more volatility there is in the equity markets, the more premium that we're going to get from writing those call options as well. So that's one way in order to, like we say, monetizing that volatility. So as volatility goes up, the yield on these ETFs tend to go up as well. But again, they tend to be more defensive than just owning, just straight up equities, just because, on a downturn, what we're doing is that because we're receiving the premiums, that tends to soften the downside risk of the underlying equity portfolio as well. We are limiting the downside to a degree, just because as we're writing the calls, potentially you cap some of the upside gains depending on which strike levels we are writing those call options. But again, with our strategies, what we're doing is we typically don't write on the entire portfolio. We write on 50 to 60% of the portfolio. So you still get to participate on the upside, but you still get the benefits of that covered call strategy. So one thing I would highlight is that not only do covered call ETFs provide lower volatility, just because you are getting those premiums on the downside, but they are tax efficient as well. So that, the dividend portion is obviously taxed as dividends, which is more beneficial compared to fixed income. But on top of that, the call option premiums are taxed as capital gains. So that's another benefit of covered call ETFs as well.
Thanks, Alfred. And if you want to learn more about our covered call ETFs, we did a really great session a couple of weeks ago. We had Richard Ho from the Options Exchange and our very own Chris Heeks talk through that. That's on our YouTube channel if you'd like to learn more. Now, within the defensive equity spectrums, there are ETFs that provide other option strategies beyond just kind of a straight up covered call strategy that a lot of investors, do-it-yourself investors, are familiar with. And some of these option strategies incorporate put rights as well. So we're just using ZPay, so BMO's Premium Yield ETF, as an example of an ETF out there that uses a put right strategy in addition to a covered call strategy. Now, I don't have time today to dive into the nitty gritty of the entire strategy. We do have a fantastic podcast on etfmarketinsights.com that talks through it if you'd like to learn more about it. But what I want to highlight with option strategies that use put rights like ZPay is that often the portfolio will hold a portion of cash to cover the puts when they get called. And when markets cool off or sell off or decline, puts tend to get called, and then the cash allocation goes down and the equity portion of the portfolio goes up as you're buying up those equities. So a portfolio like this actually has a much lower beta than the broad US equity market. And looking here, ZPay's beta is 0.43, and it has a lower standard deviation as well. So by two risk metrics, and a cover call or a put right strategy within an ETF like ZPay is much more defensive. And what I'm showing you here on the right hand side of your screen is how ZPay performed during the market turmoil of March 2020. And because the portfolio started off with a large cash position, it was able to outperform the S&P 500 when the S&P 500 crashed. Now, in up markets, ZPay and other strategies like it generally will lag the S&P 500 because of that cash portion, but something to consider as these are higher yielding products as well. so you can kind of get paid while you wait or ride out market volatility, as we say. So we gave you a few ideas today about putting cash to work using ETFs. This is our ETF roadmap. We have it on etfmarketinsights.com with so many ETF tickers out there to choose from. We think this is a really neat and tidy way to show you some of the options available to you as an investor. So check it out if you'd like to see the tickers, but here are some that we talked about today. We have a few very good questions and we have some time to take them. So the first question here is on ZPay's underlying stock portfolio, and this particular audience member is concerned the portfolio is too growth oriented and thinks that could be adding risk to the portfolio. What I will tell you, the way we manage this equity portfolio, we actually do a quality screen on all the equities we hold within this portfolio. We're very deliberate about that. We look at things like return on equity. We look at things like debt to equity. We make sure cash flow on balance sheets is strong for these companies. And the portfolio holds companies like Microsoft, like Apple. These are blue chip strong companies that we are confident to purchase when the market sells off. And we think that quality screen really, really helps keep this portfolio very high quality. But if you'd like to learn more about it, check out that podcast on etfmarketinsights.com. We have a question on preferred shares. Alfred, are you able to take this? You are our preferred share expert at BMO.
Sure. So quite a lot to unpack with this question. So one thing I'd point out is that, most preferred shares in Canada are what we define as rate reset. So basically their dividends reset every 5 years if they're not called. So just to go over quickly, the dividend formula is basically the prevailing 5-year Government of Canada rate plus some kind of a reset spread, which is essentially the same as a credit spread for corporate bonds. So generally in a rising interest rate environment, they tend to be pretty good hedges against rising interest rates. Just because that dividend resets to the prevailing 5-year Government of Canada. But one thing I will point out is that they are credit-related products. So widening credit spreads will also have an impact on preferred shares as well. Just to answer the other questions, the correlation to stocks tends to be very low, which makes them great asset allocation tools. And tax treatments or taxed as dividends, which is a big reason why they're popular with a lot of fixed income investors. And ETFs do make sense in terms of getting preferred share exposure, just because they tend to be a lot more liquid than the underlying market, which is why we get a lot of institutions using the ETFs rather than going to the underlying market directly.
Great, thanks, Alfred. Last question here is on ZTIP. So this investor saying they are seeing it showing a capital loss, and so is ZTIP.F. Can you explain why this is?
Yeah, for sure. I mean, I think you brought up a good point earlier on, just talking about inflation and the hurdle rate. So when you're investing in TIPS or Treasury inflation protected securities, it's really the break-even rate that you should be looking at, right? So I don't know when this investor bought it. When I just looked at the year-to-date returns for ZTIP, which is the unhedged version, it's 1.8% positive year-to-date, and then ZTIP.F, which is negative 90 basis points. Obviously, the US dollar exposure has been beneficial for the non-hedge version. But we're just looking at the performance so far year to date. Break-even rates did go up pretty significantly in the middle of February to the end of March, and I suspect that's perhaps when they bought it. But again, as that break-even rate goes up, the hurdle rate essentially moves higher. So inflation has to come in over a higher hurdle rate for TIPS to perform well. So I suspect that is what happened without knowing when the investor bought it. But just keep in mind, over the last couple of months, that break-even rate has come back down, which again makes a lower hurdle rate for TIPS in general.
Thanks for talking us through that. That's great insight. Well, thanks everyone for joining us. We hope you learned a lot in today's session. As a reminder, next weekend is the long weekend. We will be off, but check out our YouTube channel. We have tons of content there if you are hungry for more. And on Friday, May 27th, we will be back. We will be live, and we will be with Larry Berman. Really excited to have him on the show. We're going to talk about many different topics. So send your questions in if you'd like Larry to take them, and we'll see you on Friday, May 27th.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.